Hey, so this year has been definitely slower in terms of deal flow, and that's going back to last year as well. The last 2 years have been really slow in terms of us, Fortress Federation, being able to put out deals to investors for them to decide if they want to move forward on an opportunity. You know, because you're seeing deals or not seeing deals doesn't mean that we're not seeing deals. We're actually seeing a fair amount of deals, evaluating them, and for the most part, deciding to pass. So I thought it would be a good exercise to kind of give some insight as to why we'll pass on a deal and why you won't even see it. We won't even really bring it forward because we just don't think it's worth it. And I just want to say, I'm not going to name any names here, and I'm not trying to be disparaging about this team. I think they have a lot of potential, and I love the market they're in. I was very intrigued by the deal. Of course, I wanted to do the deal, but of course, you're not going to do a deal if it's not worth pursuing, which is what we found out in our analysis. So I'm going to share my screen and just kind of go over a few items, and this should be kind of helpful. It could help you look for things on your own in terms of what works and what doesn't work for doing a deal. So I'll start with operating reserves, or actually, let's start with replacement reserves. But before we even say or get into the numbers, this was a 1970s vintage. So that's a little earlier than we like to go. We try to make the cutoff around mid 80s, sometimes early 80s. It kind of depends on what sort of infrastructure is there. Has the plumbing been replaced? Has the roof been replaced? Has the wiring been replaced? If that infrastructure is intact, and we can put most of our money into some of the more curb appeal type features like the interiors, that's going to attract the right investor, we might consider it. But this was late 70s, like I said. So it had a lot to overcome right there. The neighborhood itself wasn't too bad, so that's why I did a deeper analysis. I thought, well, if it's a little early and it's in a good neighborhood, maybe there's some potential there. But one of the first things I saw, replacement reserves. Now, just a good rule of thumb for you to know, on newer vintages, $250 per door annually is a good number to keep as a rule of thumb. That's sort of been up to $300 annually, and definitely on older vintages, you want to see $300 per door annually in terms of replacement reserves. Every year, you're building back those reserves so you never run out of capital, which is one of the main things you have to be aware of. Is the project well capitalized? And I felt that this project was not, and that's one of the main reasons why we passed on it. You'll see here, there's another rule of thumb that you want your operating reserves to be. There's a couple of rules of thumb. One is 5 months of total expenses. Another good one that is used is 3 months expenses plus 3 months debt service. So the mortgage, basically. So if we look at this one, we'll take total expenses, which are here, year one. I'm just going to divide that. Just to annualize this, I'm going to say take year one, divide that by 12, and then we're going to multiply that by 5 months, the first rule of thumb I mentioned. And that's total reserves of $626,000 and change. The other rule of thumb I mentioned was taking expenses, divide that by 12 to get the monthly figure, and then multiply that by 3 months. That comes out to $375, but then we want to take the debt service, which is here. So we're going to do the same thing here. Take that. That's the debt service divided by 12 months. Multiply by 3. 286. So now we're going to combine that. I think I forgot to add my plus symbol there. Oops. And you have $664,000. So this is sort of more the norm. This, come back there. And this other one, they're about, they're similar, right? They're in the $600,000 range, just over $600,000. So yeah, take your pick on rules of thumb. Let's see where they were And you can see they're at $300,000. So that's less than half of what we expect to have in terms of, they call it working capital. Same thing, OPEX. You can use those interchangeably. Something else I found that was just, this is just kind of a pet peeve. It was tough to find things here. And I noticed there would be, they would say, well, you can find the interest reserves over here. And why isn't it just not plainly stated? Especially when you have multiple partners coming in, you just want to make sure that stuff is clear. And it was also different in the underwriting, from their underwriting to their deal deck, their investment summary. You had different numbers, so it was confusing, like which one was the correct number. I think the biggest difference or reason that we felt we couldn't move forward with this deal was when it comes to just doing the renovation schedule. How quickly can you finish your business plan? So do the value and where there's going to be down units. You're taking those down units, you're renovating them, you're charging higher rents, and you're moving new tenants into those preferable units that are going to increase your rent and increase your bottom line. And after doing our analysis, we just found out that it was in our opinion that they didn't have enough of an allowance for down units, meaning there was going to be more vacancy than they were planning for. And obviously vacancy, that's your biggest culprit in terms of return. So we just felt that they were kind of having an optimistic view of getting these units turned and not allowing for the vacancy that was actually going to occur and bring down the overall returns. And then there was just a few other things. They underwrote the deal for 5 years, but this was an assumable loan. There was only four and a quarter years actually left on the assumable loan. So you didn't have 5 years to get through the business plan and to do all the other things necessary to achieve the returns that they were projecting. You really only had 4 and a quarter. So we were, the underwriting was off by about 3/4 of a year. You just didn't have that time, and that impacted it. So you take all that into consideration, and you look on the surface, the investment returns looked pretty solid, almost 18% IRR. The equity multiple was 2.13. The cash on cash was 8.65. But if we look at the returns that we underwrote, let's just compare them. Average annual return, here they have it down here. Theirs was over 22%. Ours was just over 9%. Then you can just go on down the line. Our IRR, almost 18. We actually use XIRR, which is a little more accurate. That was 9. So about half. Cash on cash, theirs was over 8. Ours was just over 6. And then equity multiple, they were saying 2.13. Well, so that's 113% total return. That's a nice number. We were only having 1.4x or 40% total return. So I'll stop sharing. You can see there's quite a disparity in their numbers versus our numbers, and we felt really good about our analysis. We were careful. And this is just the type of stuff that we go through to bring forward deals out to our investors. And unfortunately, this year it's just been slow, and we're not finding the returns that we require to put forth an opportunity. So I hope that helps. Try to make note of some of those rules of thumb and try it on your own. You can look at our deals, the deals that we bring out, see how well capitalized they are. If there's, in this case, if there was over $600,000 in return, $600,000 in return, you would know that met the rule of thumb, and you could feel pretty good about being capitalized. And in addition to the replacement reserves that I mentioned, where you want a minimum of about $250 per door annually. All right, so I hope you found that useful, and we'll do it again soon. We always have deals coming out that we pass on, and we'll share some of the insights from those deals. All right, thanks. We'll see you next time.